Hi, this is Manish Gunwani. I'm the fund manager of Nippon India Growth Fund, and it's very nice to talk to you again about the fund. Now, let me just start with our overall view on how we see the global economy and the domestic economy, then talk about how the fund is positioned. When we look at the global economy, clearly from last year's big crisis of Corona, we are seeing that the global economy continues to recover. There's been massive liquidity injected into the global economy, which is good for equities. There's been massive stimulus given from the governments, which has helped the global economy recover faster than expected, which has clearly played out in terms of global equities doing well, global corporate earnings doing well. So what we are seeing is all the regions which recovered from the virus have sequentially done well. So China did well last calendar year because it did not get affected so much by virus. US, UK have started doing well because they vaccinated aggressively. And now Japan and Europe are recovering because there too the vaccination has picked up. So one of the biggest positives we've seen is that the vaccines have definitely worked. Although with the Delta variant, you're seeing a lot of cases also go up in some regions. But the important point to note is that the hospitalization rate, the death rates are not going up that much, which is allowing these regions to open up. And our expectation is that as more and more countries open up, including the emerging markets like India, Brazil, etc., which got hit by the second wave, the global economy will continue to recover. We will see strong data for next 1.5 year. Now, the global liquidity, on the other hand, it's difficult to go up from here. So we are seeing normalization by different central banks after the massive liquidity that was injected. And so when we see at global markets today, they are in a situation where the earnings are coming out fine. But given the liquidity scenario being a bit balanced, you're seeing a consolidation phase in global markets. So that's on the global economy. On the domestic economy, I think things are looking much more clearer that India, we think, has a very optimistic outlook today in terms of the macro. You have a lot of things going for the domestic cycle. There is huge pent-up demand in consumption. In capex cycle, after 7-8 years, things are looking up. Interest rates are at multi-decade low. The fiscal spending is quite healthy. And the banking sector is cleaned out of almost all big problems because whether it is infra, commodities, NBFCs, a lot of these issues over last 6-7 years have been sorted out. So as far as India is concerned, India has been kind of growing below potential for almost 6-7 years now. And we think after such a long period of below potential growth, India has a bright chance of reverting to the mean and going back to high growth phase. And we're more positive on the domestic cycle versus the global cycle. In terms of risk, the key risk remain that this whole liquidity injection that has happened globally by central banks, whether it will be pulled back too soon versus what the market expects. We should all, I think, recognize that as economies recover, liquidity will be pulled back, interest rates may go up, but it's the pace that matters. Obviously, earnings is also going up. So it is that balance of interest rates and liquidity versus earnings growth that is important for global markets. So let's all move on to the fund now. So as you may recall, the Nippon India Growth Fund is a mid-cap oriented fund where our focus is to own small and mid-cap companies, which we think will grow into large companies, which can compound earnings at a healthy pace. And for that to happen, we typically look at four verticals which we think grow faster than nominal GDP in most countries. So these four are basically consumer discretionary, which includes auto, retailing, etc. Because as consumers become richer, they spend more money on discretionary items. Financials, third is healthcare, and fourth is outsourcing to large corporates globally, which covers segments like IT, chemicals, etc. So these four verticals, we believe, over the many years ahead, will continue to grow faster than nominal GDP, and most of our portfolio, therefore, is in these four verticals. So let me just talk a bit about what has worked for us over the last year or so. Essentially, what we've done as the global economy is recovered post the virus is to move to value cyclical kind of style, and across sectors, we had the cheaper stocks, the more cyclical stocks. And as economies recovered, particularly since last November when the vaccination news turned positive, we saw globally that there was a lot of optimism about the economy, which has played out with the global economy recovering. So a lot of these cyclical sectors like metals, auto exporters, financials, a lot of manufacturing companies in chemicals, textiles, we have owned, and that has worked for us. Some of our more defensive holdings have not worked, and that has pulled down performance a bit, especially on the healthcare and pharma side. But broadly, the fund has been able to capitalize on this value and cyclical trade, which worked better from November to April, and last 2 3 months it's been more balanced. So last few months, we have also toned down our portfolio from a heavy value and cyclical positioning, because we think a lot of the global economy recovery is priced in. If you see the US bond yields are now flattening out or dropping, which means that the outlook on global inflation, global economy is not that strong as it was 6 9 months. Also, the valuations available in stock prices are not as attractive as about a year back. So we have moved some weight from global cyclicals to domestic cyclicals as well, because we think the next phase of economic growth recovery will be more prominent in the domestic economy than the global economy, because the domestic economy also got affected by the second wave, whereas overall the global economy did not suffer as much. So we have moved weight from steel and auto sector, auto exporters kind of sectors to domestic cyclicals like banks and industrial, cement, etc. The other theme which we like going forward is the outdoor consumption theme. Now, over last 15 months or so, across the two COVID waves, clearly what has happened is that Indian consumers have not been able to travel. They've not been able to go to movies. They've not been able to go to restaurants. And we think a lot of that will come back over the next 6 months to 12 months. We believe that with vaccines working globally, as well as the fact that India, if you see the servo prevalence study, there is a case to be made that India may not likely suffer a big third wave. So with those assumptions, we believe that outdoor consumption stocks represent a good risk reward. So across segments like alcoholic beverages, retailing, multiplexes, hotels, aviation, there are select stocks among these many segments where we have a reasonable position. And as I said, basically, as Indian consumers are able to go out, and we think also that Indian consumers, especially the top 15-20% of households, have a healthy balance sheet in spite of the crisis we've gone through. because the lending or the borrowing from the system is much less for these top 10-15% household versus the assets they've saved over the last many decades. So if you see the amount of financial assets, the amount of real estate, the amount of gold, top 10-15% of households have versus what they've borrowed from the banking or NBFCs, it's a very healthy balance sheet. And I think, therefore, the ammunition to spend, given that there has been so much pent up demand for events, marriages, temples, etc. Um, we do expect that next 6 to 12 months, a lot of these outdoor consumption segments will do very well. Uh, the third theme, which we are positive on, although selectively because valuations are definitely expensive, is all the new age, new technology, internet, gaming, aggregators. Some of them are already listed, some of them will get listed. And while valuations are obviously something which are very tricky here because a lot of these companies are very small, they may not be very profitable at this point of time. But we do believe that this is an age of disruption. Some of these smaller companies will become very big companies. And we're trying to selectively own some of the long-term winners, where we see a combination of a large addressable market, management which is very competitive in executing that opportunity, and where valuations seem reasonable, at least on a medium to long-term view. So with that lens, we are hoping to get some big winners from the new age business models that are coming in the mid and small cap space. I'm going to end here by saying that Nippon India Growth Fund has performed well, and you could consider it as a part of your core portfolio.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.